At different points in your retirement, you are going to have the ability to realize income in a 0% tax-free bracket. Now, there are a few different tax-free zones within your retirement. Now, when is the optimal time, though, to use these tax-free zones to move your retirement forward into the future? Unfortunately, too often I see retirees improperly using these 0% zones, and that's exactly what we're going to fix in today's video. Let's get into it. So the first tax-free zone for retirees is the 0% long-term capital gains bracket. Now, we know that long-term capital gains offer a preferred rate for retirees, and both for a single filer as well as a married filer, there is a 0% long-term capital gains zone where you can take unrealized gains from your taxable account, realize those gains, and pay a 0% long-term capital gains rate. Now, a powerful strategy for retirees to utilize is essentially realizing gains inside of this 0% zone. This is called tax gain harvesting. Essentially, how tax gain harvesting works is if you have a tax base that is underneath the long-term capital gains 0% zone, you can realize unrealized gains and pay nothing in taxes. So let's go through an example of exactly what I mean here. We have a couple who just retired and they have a tax base of $42,000 and they have a taxable account that has $350,000 in it, and $166,000 of that is unrealized gains. And so the 0% zone ends at $83,350 for a married couple in 2022. And so basically what this couple can do is they can take part of those unrealized gains and they can start realizing those gains to fill the tax base that they have from $42,000 up to $83,350. Essentially what they're doing is they're resetting their cost base, and they're doing so at a 0% long-term capital gain rate. Now, this is a fantastic strategy that retirees can use to kind of turn a taxable account into a tax-free account if you're realizing gains inside of that 0% zone. But unfortunately, too many times I see retirees use this at the wrong time. For instance, a lot of times I see retirees use this in the first part of their retirement when they're in some low tax brackets right when they retire and are not yet on Social Security. And so this folds right into a question that we often receive from retirees. Should I be realizing long-term capital gains in that 0% bracket, thus tax gain harvesting, or should I prioritize a Roth conversion? Well, let's go through an example here. We have an early retiree who is in some of those low brackets. They're trying to decide, should they prioritize a Roth conversion of $100,000, which they'll pay an effective tax rate of about 16.8%, or should they realize some unrealized gains within that 0% long-term capital gain zone? Now, many of us look at this situation as we're paying more in taxes, paying 16.8% in taxes on that conversion, or we can realize in a tax-free way inside of that 0% zone. So most of us go to grab that 0% long-term capital gain rate. And unfortunately, in 9 out of 10 cases, this is a mistake. First off, we know that long-term capital gains have a preferential rate relative to ordinary income brackets. So if we're at a $100,000 tax base and we're married filing jointly, then if we take money from our tax-deferred accounts, we will be paying 22% in taxes. If we take money from our taxable account and we pay long-term capital gains, we'll only be paying 15%. And so there's a benefit to keeping money within our taxable account because it has preferential rates that we can use down the road. And if we think about it, what's going to prevent us from being in this 0% long-term capital gain zone into the future? Well, for the most part, it's really going to be required minimum distributions. RMD at age 72, we're going to be forced to take from our tax-deferred accounts, which can push us up past that tax gain harvesting zone. Given this, why would we prioritize tax gain harvesting versus performing Roth conversions? Because if we perform Roth conversions, maybe we can set ourselves up for an opportunity where our RMDs are small enough that later into retirement, even once we're on RMDs, we are in that tax gain harvesting zone. And then we have a longer term stretch where we can tax gain harvest and benefit our retirement. So it really doesn't make sense to tax gain harvest and forego a Roth conversion in most cases. So tax gain harvesting can be an awesome strategy to utilize on an ongoing basis when we find ourselves in that 0% long-term capital gains bracket. But earlier in retirement, oftentimes you should be prioritizing Roth conversions and foregoing that 0% long-term capital gains bracket in order to set yourself up for a long-term 0% long-term capital gain bracket. Now, many retirees don't think about the second tax-free zone, but is one that every American has available to them, and that's the standard deduction. Now on the screen, you can see the 2022 standard deduction for both a single filer as well as a married filer. Also, it's important to note that once you're over the age of 65, you receive an add-on to your standard deduction. Now, the standard deduction is essentially a break that the government gives you where you can fill up a certain level of income without being taxed at all. And so the standard deduction is a great 0% zone to fix some of your worst taxed withdrawals. Now, specifically for most individuals, this will be your tax-deferred withdrawals. They are taxed at ordinary income rates. And so for most retirees, this is the opportunity to take from your tax-deferred accounts up to a given extent and pay 0% on those tax-deferred withdrawals. The standard deduction is the reason why most retirees shouldn't work on converting all of their IRA assets, because on an ongoing basis, you will have a window of opportunity each and every year to realize some of those tax-deferred withdrawals at that 0% rate because you're underneath the standard deduction. So on the screen, you can see a snapshot of someone's Social Security tax torpedo graph. And as you can see, at each income level that we're looking at, it shows where we should be prioritizing withdrawal strategies in order to have a tax-efficient strategy. And as you can see in the standard deduction and even the smaller ordinary income tax brackets, we should be prioritizing tax-deferred withdrawals. And then after that, if we have decent tax bucket diversification, then taking from taxable accounts, finally taking from Roth accounts, to avoid some of those hurdles and double taxations that we see so often in our retirement. And so let's move on to your third 0% zone, and that would be Roth withdrawals. And so when is the optimal time to utilize your Roth IRA within your tax-efficient withdrawal strategy to deliver tax savings to your situation? The first path is for early retirees, those that are retiring prior to 65 and entering onto Affordable Care Act insurance. Now, we talked about this a lot within our Safeguard Wealth Management YouTube channel, but the amount that you pay for healthcare on ACA insurance is directly tied to your reported income. If you can report a low enough income, you can earn a healthcare subsidy. That healthcare subsidy lowers both your premiums as well as your out-of-pocket costs. And here's an example of how powerful a subsidy can be. If you're a single filer and you do not earn a subsidy, your healthcare insurance could be more than $1,000 per month on an ongoing basis. If you earn a very large subsidy, your healthcare insurance could be really premium free. You could pay $0 per month for health insurance. So there are a lot of things that are counted against you in terms of your reported income. We have a snapshot on the screen. And so we would expect a lot of these things to be counted against us in terms of our reported income. But there's one thing here that is not counted against us. It's one thing that we can use in order to report a low income, but still take a high income to spend how we'd like in retirement. And that's Roth withdrawals. And so your Roth IRA can be utilized in a fantastic way to translate to significant healthcare savings, especially earlier in retirement. Again, this can be a gap for a single filer of as much as $1,000 per month in healthcare savings, which is a huge savings, all things considered, especially early on in retirement. The second way to utilize Roth withdrawals within your retirement situation is for those that have very good tax bucket diversification. Now, for a retiree, this would mean that their tax-deferred accounts aren't enormous. They have some money in those taxable accounts, and they have a considerable amount of money in Roth accounts, either from Roth conversions earlier in retirement, or they even saved that way while they were working. And for somebody that has this tax bucket diversification, here's what an optimal withdrawal strategy might look like. Now, once they're on Social Security, they have Social Security as their base income. Then they start to fill in tax-deferred withdrawals within the standard deduction and even within some of those lower brackets, as we just discussed in the last section. Now, from there, they still have room within that 0% long-term capital gain bracket where they can take some of those unrealized gains and realize some of those gains, again at 0%, either for income or just to realize those gains for future income needs from that taxable account. And then finally, after they're through that 0% bracket, then they'd prioritize Roth withdrawals. Now, as you can see from this example, this retiree is in a fantastic tax situation to manage some tax-efficient withdrawals from their given accounts. Lastly, we'll talk about a retiree that is in what I would call a tax mitigation scenario. Now, this is someone who has some very large tax-deferred accounts, and earlier in their retirement, as they're delaying Social Security, we can't convert enough at reasonable rates in order to eliminate a lot of their tax-deferred issues. So there's someone who's going to enter into their 70s and have some RMD issues. We're simply trying to mitigate as well as we can through time. Now, this is a good problem to have, all things considered, but whether it's a good problem or a bad problem, it's still a problem that we need to fix. Now, for somebody like this, they're going to be doing some Roth conversions earlier in retirement and building up those Roth accounts. But they're likely going to be in a situation where they never really realize those Roth withdrawals. And the reason being is because, again, once RMDs start, maybe those RMDs fill their income need, or maybe they still have RMDs that are up and above their income need. And so there's really no room to take Roth withdrawals because, again, their income need is filled. And so this is a retiree that may never realize their Roth withdrawals for their situation. It's simply going to be a powerful estate planning tool as they pass wealth on to the next generation. Now, this is a smaller group of retirees, but nonetheless a situation that is worth mentioning. Now, it's important to note that certain retirees may have additional tax-free zones. For instance, if you have life insurance that you're taking from, that might create a 0% bracket that you can use. Now, utilizing that 0% account is going to be very similar to how you would prioritize Roth withdrawals, as well as prioritize this final 0% zone that we're going to talk about, which is the 0% zone that is created by utilizing your health savings account, otherwise known as your HSA. Now, your HSA is an account that's specific for medical expenses. The account is very unique because when you contribute to this account, you get a tax deduction. You receive tax-free growth within this account, and then if you withdraw the money from this account and use it for qualified medical expenses, you pay nothing in taxes on that given withdrawal. Now, this account gets a little bit more complex in how we utilize this for our retirement. The reason being is because there is a tug of war that is happening here. Now, we ultimately want to grow this account because we always want to grow our tax-free buckets. But specifically for a health savings account, when you pass that account on to the next generation, it is a very tax inefficient account. The reason being is because when someone inherits an HSA outside of your spouse, they have to take all of the money from that HSA. It's all taxable dollars in the given year that they inherit that account. So how do we think about growing this account to create more tax-free dollars within our retirement, but also utilizing this account to make sure that we don't pass it on to the next generation? A timeline for how most people should think about using their HSA. The first zone, the first segment of retirement here, early in retirement, we view this as a preserve and growth zone. The reason being is because, again, we want to keep growing this HSA. For many people, they won't have as many dollars in their HSA account. And so we want to grow this powerful tax-free account. Now, the one exception to this rule would be if somebody already has a very large HSA for whatever reason, they may actually want to utilize some of their HSA in that first segment. From there, we see segment 2 is really the utilize phase. And again, you would utilize this fairly similarly to how you would utilize Roth withdrawals. It just so happens that when we think about medical expenses as we move through retirement, the majority of our medical expenses will be realized within this second segment because, again, as we age, we expect to spend a little bit more on our medical expenses. And so in this preserve and growth zone, we typically want to be investing our HSA quite aggressively. Now, oftentimes this might mean that we experience quite a bit of volatility within our HSA. And if we have qualified medical expenses, this might mean that we forgo paying it out of our HSA and instead pay it out of pocket. Yes, you did hear me exactly right. By paying healthcare costs out of pocket, you can use something that we call the HSA receipt loophole. I'm going to link to a video right here that explains this concept in depth. Essentially, what you can do with this receipt loophole is you can supercharge your HSA growth, pay healthcare costs out of pocket, and then later claw back those costs from your HSA completely tax-free, and thus preserving and growing that HSA account for the future. This is a powerful strategy that you don't want to miss out on.